Hello everyone, a huge warm welcome and thank you so much for coming to watch this video today. We really appreciate you spending your time with us for this deep dive. It is Thursday, February 26, 2026, and today we are looking at the fresh results from Diana Shipping Inc.
That's right. We are unpacking their fourth quarter and year-end 2025 earnings. And I have to say right off the bat, if you think shipping is just about, moving boxes or piles of dirt from point A to point B, this review might seriously change your mind. This was definitely not a standard boring earnings call.
No, not at all. It felt a lot more like a dispatch from the front lines of a really strange global economy. I mean, you have trade wars, you have what they're calling Liberation Day tariffs, and a company that seems almost bored with just moving cargo. They've decided to launch a hostile takeover of Arrival instead.
Yeah, it is a very aggressive, very pivotal moment for Diana Shipping. They are navigating this chaotic macro environment by basically trying to brute force their way into a larger market share. It's bold, it's risky, and the financials are, well, let's just say they are pretty complicated.
They really are. And we are going to get into all of that today. We're going to cover the hostile bid for Genco, the falling profits, and the incredibly strange silence from Wall Street. But first, let's set the stage and summarize the company's prepared presentation.
Right.
So the CEO, Semiramis Paliou, opened the presentation by describing 2025 as a tale of two halves. What exactly happened last year to warrant that description?
It was just a year of extreme volatility. The first half of 2025 was honestly a bit of a hangover. The market was very soft. You had demand for coal decelerating. And even iron ore imports into China, which is usually the absolute heartbeat of this industry, were dipping. Rates were low. Sentiment was poor. It really looked like a recession for shipping.
And then the script just flipped.
Completely flipped. The second half hit, and we saw a broad-based recovery across all vessel sizes. But, and this is the absolute key to understanding this entire report, the recovery didn't happen because the world suddenly started buying way more stuff.
See, that seems totally contradictory to me. Usually, shipping booms when consumption booms. If people aren't buying more, why on earth are shipping rates going up?
Because the global system got incredibly inefficient. The CEO used a very specific term for this. She called it utilization tightening.
Utilization tightening. That sounds like classic corporate speak for, we got busy. Let's decode that for the listeners. What does that actually mean on the water?
It is a bit more technical than just being busy. Think of it like this. Imagine you are a taxi driver in a city. If you drive a passenger 2 miles down a straight road, you can do maybe 20 trips a day.
Makes sense.
But if the main highway is closed and you have to take a winding back road that is 10 miles long to get that exact same passenger to the exact same destination, you might only do 4 trips a day.
So the passenger still gets there, but the taxi is occupied for way, way longer.
Precisely. And in shipping, we measure this concept in ton miles. It's the volume of the cargo multiplied by the distance it travels. In the second half of 2025, ton miles just skyrocketed. Ships were traveling much further distances to deliver the exact same amount of iron ore or grain.
Why the longer routes, though? Was this the geopolitical angle coming into play?
Exactly. This is where the politics of 2025 really hit the water. We had those Liberation Day tariffs announced by the U.S. back on April 2nd, and that was followed by heavy retaliation from China in October regarding the trade representative fees.
Right. The shock and awe politics.
Yeah, these shock and awe political moves totally disrupted traditional, efficient trade routes. Buyers couldn't just buy from their closest neighbor anymore. They had to source goods from much further away just to avoid the tariffs.
So just to be clear, political dysfunction and global inefficiency is actually highly profitable for the ship owner.
In the short term, absolutely. If a ship is tied up for 40 days instead of 20, the total supply of available ships in the world tightens up. There are fewer ships available for the next cargo, so the price to hire a ship goes through the roof.
And we saw that in the rates, right?
Big time. Cape-sized vessels, these are the massive ships that carry iron ore, they went from earning less than $10,000 a day in the first half of the year to a peak of $45,000 a day in December.
Wow. That is a massive swing. But isn't there a huge risk there? If the market is only up because of inefficiency, what happens if things suddenly normalize?
That is the exact danger. It's an artificial high.
Yeah.
But Diana Shipping seems to be betting that this geopolitical friction is just the new normal. They are running their fleet incredibly hot right now. They reported a 99.7% utilization rate.
Meaning they basically don't have a single ship sitting idle.
Right. Every asset is working.
Let's talk about the hardware involved here. You mentioned Capesize. What exactly does Diana have in the water right now?
They operate a fleet of 36 dry bulk vessels. It's a mix. They have the Capesizes we mentioned, which are literally too big to fit through the Panama Canal, hence the name. They have to go around the Cape of Good Hope or Cape Horn. And they also have Panamaxes and Kamsarmaxes.
Kamsarmax, I always stumble on that one. It sounds like a dinosaur.
It really does. It's actually a very specific vessel size designed to be the absolute maximum size that can safely enter the port of Kamsar in Guinea, West Africa.
That is oddly specific. Why design an entire class of ship for one single port in West Africa?
Because of bauxite.
Hmm.
And this is a crucial nugget from the commercial officer, Dave van der Linden's update. While the coal trade is dropping, seaborne coal fell 5% in 2025 as the world tries to decarbonize. Bauxite is the star performer right now. Bauxite is the raw rock used to make aluminum.
And Guinea is the main source.
Guinea is the global hub for high-quality bauxite. And where is all that bauxite going? Mostly to Asia to be processed. That is a very, very long trip. So you have these Kamsarmax and Cape-sized vessels hauling rocks from West Africa all the way around to China. It's a huge driver of those ton miles we talked about earlier. Bauxite ton miles actually grew faster than iron ore or coal last year.
They also mentioned grain, right?
Yes, the fourth quarter saw a 5-year high in Chinese soybean imports, mostly coming all the way from Brazil. Again, long distances padding those ton miles.
Okay, so the operational side is clearly very busy, but I want to pivot to the boardroom because that's where the real heat was on this earnings call. The Genco situation.
The elephant in the room.
Or perhaps the whale in the room, given the size of it.
For those who haven't followed the soap opera, catch us up on the drama. Diana Shipping wants to buy Genco Shipping. Why is this turning into a street brawl? Right. So Diana already owns about 15% of Genco, which trades under the ticker GNK. Back in November 2025, Diana made a formal tender offer to buy all the remaining outstanding shares for $20.60 per share in cash.
$20.60 cash. Was that considered a fair premium at the time?
At the time, it was a very significant premium over the trading price. It was a serious put up or shut up offer to the shareholders.
And how did Genco respond? Did they try to negotiate a better price?
They didn't. According to Diana's management on the call, the Genco board refused to engage entirely. Total radio silence. They essentially ignored the offer.
That seems almost negligent. If someone offers to buy your house for above market value, you at least answer the door to say no, right?
You would think so. But Genco's board seems to believe the company is worth significantly more, or perhaps they just fundamentally don't want to be acquired by Diana. But Diana didn't take the silence as a no, they took it as a declaration of war.
Escalation.
Major escalation. Just last month, in January 2026, Diana nominated 6 new director candidates to replace the entire Genco board at the upcoming annual meeting.
So this is a classic hostile proxy battle, basically saying, if you won't talk to us, we will ask the shareholders to fire you and hire people who will.
Exactly. It shows Diana is in a very aggressive, expansionist mood. They aren't content with their 36 ships. They want Genco's fleet to scale up massively. They want to be a giant in the sector.
But here's where I get stuck. Let's move to the financials, presented by co-CFO Maria Dege. For a company trying to aggressively buy a rival, their own numbers for Q4 seem, well, a bit mixed.
They were definitely softer than the previous year. If you look at the time charter revenues for Q4, they came in at $52.1 million. That's down from $57.1 million in Q4 2024. Adjusted EBITDA was down to $19.3 million, and the bottom line took a real hit. Net income dropped to $3.1 million, down significantly from $9.7 million the previous year.
That is a steep drop, a roughly 68% drop in net profits. If I'm a Genco shareholder, am I looking at Diana and asking, why should I let you run my company when your own profits are tanking?
It's a very fair question, but you do have to peel back the layers of that onion a bit. Part of that revenue drop is simply because Diana sold 2 vessels, the Alkmene and the Selena. When you sell the factory, you produce less product. That reduces their earning days. It was a strategic choice to offload older assets, combined with some lower time charter rates compared to the previous year.
Okay, so they shrank the fleet slightly, which explains some of the top-line drop.
Right. But the concerning part for me wasn't just the revenue, it was the expenses. Daily operating expenses, which they call OPEX, jumped 11% to $6,123 per day per ship.
Wow. Over $6,000 a day just to keep a ship running? Inflation strikes again.
It's that sticky inflation we keep hearing about. Crew wages are up significantly. It's getting much harder to find skilled seafarers. Stores, supplies, repairs, everything costs more. When you are running massive steel assets in highly corrosive salt water, maintenance is non-negotiable. An 11% hike in daily running costs eats directly into your profit margins.
So profits are down, costs are up. How can they possibly afford a hostile cash takeover? Do they actually have the money, or is this all just bluster?
This is where Diana is actually quite strong. Their balance sheet is essentially a fortress. They have $122.3 million in cash on hand, and their debt is very conservative. Net debt is only 51% of the market value of their fleet.
So they aren't maxed out on their credit cards, so to speak.
Far from it. They have plenty of dry powder and borrowing capacity. That's why they can aggressively pursue Genco. They have the financial engineering capacity to make the deal happen, even if their Q4 operating profit was a bit thin.
Speaking of money, did the Diana shareholders get paid anything this quarter?
They did. Diana declared a cash dividend of 1 cent per share.
1 cent. That sounds practically token. Is that even worth the administrative paperwork?
It is very small. But in the context of launching a hostile takeover and funding fleet renewal, it's a powerful signal. It says, look, we're disciplined enough to keep paying you something, even while we hoard cash for this upcoming war. It maintains their status as a dividend-paying stock, which actually really matters to certain institutional funds.
Let's talk about the future guidance. The CFO gave an outlook for 2026. Usually, shipping is treated like a spot market casino. You don't know what you'll earn next week, let alone next year. But Diana seems to have hedged their bets here.
They have. This is their core defensive strategy. They have already secured time charters for 76% of their available ownership days for all of 2026.
3/4 of the entire year is already booked in advance.
Yes, at an average rate of roughly $17,670 per day.
Is that a good rate?
It's a very safe rate. Their break-even cost, the amount they need to just keep the lights on, pay the crew, and service the debt, is lower than that. So by locking in $17,670, they have effectively guaranteed they won't lose money on those ships for the year. They've capped their downside.
But they've also capped their upside, right? If rates spike to $50,000 again because of another sudden trade war, Diana is stuck earning $17,000.
That is the trade-off you make. They are sacrificing the potential home run for a guaranteed base hit, but given the high volatility and those shock and awe politics we discussed, maybe taking the guaranteed money is the smart play.
I want to go back to the supply side for a moment. We talked about demand, bauxite, grain, iron ore, but in shipping, supply, meaning the sheer number of new ships hitting the water, is usually the silent killer of bull markets. What did the CCO say about the global order book?
He raised a warning flag, a pretty big one. The order book, which is a list of new ships actively being built in shipyards right now, stands at about 12% of the existing global fleet. New building orders really accelerated in the second half of 2025.
Is 12% dangerously high?
It's getting there, but the timing is the real issue here. 2026 is expected to see the highest number of new ship deliveries in 10 years.
So right as Diana is trying to acquire Genco and expand, a literal tidal wave of competing new ships is about to hit the water.
Exactly, and it's basic economics. If supply floods the market, shipping rates crash. Unless
demand keeps up with it.
or unless the inefficiency we talked about keeps those ships tied up in traffic. If the tariffs and trade wars continue to force these massive long voyages, the market might just be able to absorb these new ships without rates collapsing. But if global GDP growth, which is expected to hold steady at 3.3%, stalls out, or if the world suddenly plays nice and trade routes normalize, we could see a serious rate collapse.
Which suddenly makes that 76% locked-in revenue look pretty brilliant. They're buying insurance against a supply glut.
Correct. It's a direct hedge against the very ships that are currently being welded together in shipyards across Asia right now.
One small note before we move on to the Q&A. They did give an ESG update, environmental, social, and governance. They achieved a B score from the CDP for environmental reporting and an S&P Global ESG score of 31%. Does this actually matter to investors, or is it just corporate box ticking?
It matters more and more for access to cheap capital. Banks are under massive regulatory pressure to lend to green companies. To future-proof themselves, Diana is actually ordering 2 new methanol dual-fuel Kamsarmax vessels that will arrive in late 2027 or early 2028.
Methanol. Is that the winner in the alternative fuel wars?
It's definitely one of the front runners right now.
Yeah.
By investing there, Diana is signaling to the banks and the broader market, hey, we aren't just running old rust buckets. We are actively transitioning to the future.
Okay, so normally this is the part of the deep dive where we move to the Q&A session. And as you know, we have a strict format for this. For each question, we list the analyst's name and firm, provide a brief summary of their question, and then summarize the company's response to that question. And we repeat that format for all questions asked.
Right, which is going to be incredibly easy to do today.
Exactly, because for the first question, the analyst's name and firm is nobody.
And the brief summary of their question is nothing.
And the company's response was the operator simply saying, and I quote, "I'm not seeing any questions at this time."
End of Q&A.
That is just bizarre to me. You have a public company, their earnings are down, costs are up 11%, and they are in the middle of a high-stakes, hostile corporate raid. And Wall Street has absolutely nothing to ask them.
It is incredibly rare. The operator opened the line, pulled for questions, and there was just dead air. It was over before it even began.
How do you read that silence? Is it indifference? Are the analysts just not interested in Diana shipping anymore?
I don't think it's indifference at all. I think it's highly tactical. The analysts know that anything management says on a public recorded call about the Genco takeover is going to be heavily scripted legal boilerplate. They'd just say, "We remain committed to the offer, we believe it is in the best interest of shareholders," and so on. The analysts aren't going to get any actionable new information here.
So they're basically saving their ammo.
I think so. The real showdown isn't going to happen on an earnings call. It's going to be at the Genco shareholder meeting. The analysts and the major institutional shareholders are likely having very intense private conversations behind closed doors right now. The total silence on the public call really feels like the calm before the storm.
It adds a whole layer of suspense to the thing. It's almost spookier than a shouting match would be.
It definitely implies everyone is just holding their breath to see which way the proxy vote goes.
So, since the analysts didn't sum things up for us with their questions, we need to do it ourselves. Let's provide a high-level wrap-up and synthesize what we've learned today from the presentation and that very brief Q&A. What are the main themes here?
Well, financially, they are still profitable, but weaker than 2024. That's due to a slightly smaller fleet and those rising operating costs. But strategically, the main theme is aggression. They are aggressively pursuing the Genco acquisition, trying to force a hostile board takeover, while simultaneously modernizing their own fleet with those new methanol ships.
And on the market dynamics side?
It's a very complex environment. The big takeaway is that geopolitical tariffs, like the Liberation Day tariffs, didn't actually kill the market. Instead, longer ton miles and distance are saving the day and driving up rates. Even though raw demand is relatively flat,
And looking to the future.
the future is all about supply risk. 2026 looks incredibly busy with new ship deliveries, the highest in a decade. That could put massive downward pressure on rates. But Diana has played it safe by locking in 76% of their revenue already, giving them a shield against that exact risk.
It really is a fascinating case study. You have a company playing extreme defense with its own fleet by locking in fixed rates, while playing extreme offense with its corporate strategy by launching a hostile takeover.
It's a hedging strategy on a grand scale. They are trying to become a giant, regardless of what the geopolitical winds do next.
Oh, we will certainly be watching that Genco closely. That is the next big domino to fall.
It's going to be the defining moment of their year, without a doubt.
Thank you so much for watching, everyone. We really hope this breakdown gave you a clearer view of the mechanics behind the dry bulk sector and the corporate drama unfolding at Diana Shipping.
It's a complex world out there, but understanding the shipping lanes really does help you understand the broader global economy.
Absolutely. If you found this video valuable, please do click the like button. It really helps us get this content to more people. Share this video with anyone you know who's interested in market trends or corporate battles, and make sure you subscribe to the channel and stay tuned for upcoming content if you liked what you saw today.
Thanks for joining us.
Thanks again, and we'll see you next time.